InFi, episode 46.
Welcome to InFi, the future of finance, hosted by American economist and author Dr. Robert Murphy. Each week, tune in for dynamic discussions with business pioneers about emerging trends in finance, life insurance, asset management, technology, and more. Now, let's talk the future of finance.
Hey everybody, welcome back to the InFi podcast. Today I'm speaking with Yael Tamar, who is the CEO and co-founder of DIBS Capital, which is a platform to make asset investing accessible, transparent, and streamlined. She also describes her professional specialty as being of fast industry and tech transformation and utilizing emerging tools like Gen AI and blockchain to advance and successfully compete in business and corporate settings. She's got 2 decades in financial markets experience. She was an analyst on Wall Street for a broker-dealer, worked as structuring products, and she's currently living in Israel. So part of the conversation is I just ask, how does the Israeli financial sector compare to that in the United States? And I should probably also mention, as it's very relevant in this discussion, she is a regional co-chair at FIBREE, so that's an acronym, which stands for the Foundation for International Blockchain and Real Estate Expertise, the leading international network for exchanging knowledge between the real estate industry participants. So, as longtime listeners of this podcast know, here at Infineo, we're taking life insurance and putting it on the blockchain. And so, of course, we like talking to other people who are also involved with the tokenization of real-world assets. So, with that background, here is my conversation with Yael Tamar. Yael, welcome to the InFi podcast.
Thank you. Thank you for having me.
Well, I already would have prepped the audience a bit on your background, but maybe just to let you expand on that, can you just give a little bit of, your story? Like, I know you spent 2 decades in the financial markets. Can you just explain a little bit of that? And I think were you actually on Wall Street at one point?
Yes, Bob, I was, but I had no idea it was Wall Street.
Okay.
It was, what it was, I should say. Obviously, I took a train every day to Wall Street and I got up on the whatever it was, maybe 12th floor of the building and right in front of the Bull. It was a broker-dealer, in fact, and I was just learning about what a broker-dealer does, what options are in all the financial instruments. It was my first ever real-world job.
Well, can I stop you? Where did you grow up?
I grew up in Ukraine, and
Okay.
and I made it over across the ocean at the age of 16, went to high school, kind of went with the flow of what life gave me and ended up in college in New York at Hunter College. And I did my internship at this small broker-dealer firm. And I was doing financial analysis of all kinds, even was involved in an application of some sort to the SEC. So it was super interesting. But, at that point, I didn't even know it was super interesting.
Uh-huh.
Yeah.
Okay. And so then from there, you spent your bio says 2 decades in the financial markets. So can you just give a little bit of background on what places you were and, what sort of work you were doing?
Yeah, absolutely. And the funny thing is, I went with the flow. I didn't have a very good career trajectory of where I wanted to get to. I took opportunities. So I moved to Israel a year after I graduated from Hunter College, and I started working at different M&A boutiques. And I didn't even know at that point that Israel was this startup nation. I didn't know until I got here and I understood
You didn't know you were on Wall Street. You didn't know this. Yeah.
I know, it's incredible. And then you get into a taxi and the taxi driver has a startup. Everybody has a startup. And this M&A boutique run by somebody who was ex-McKinsey, we were just selling companies left and right. We sold the largest agricultural company, worked with the largest real estate company. The same company ended up having an IPO, and Ernst & Young kind of pulled me in while we were working on it. And so I worked there for 2 years, kind of exploring that direction, worked on maybe 7 or 8 different IPOs. Again, I never, planned to. And even though I studied economics, I had no idea what working on an IPO would be like, and working with underwriters and the whole team and banks and things like that. It just kind of was thrown at me. And then it was difficult to work in a large demanding company. And I wanted to do something smaller. And I went to interview all the family offices and hedge funds and VCs in Israel just because. And I went to ask them like what it's like to work there. And I clicked with one specific fund of funds. And I ended up spending there maybe 6 or 7 years of my life doing all kinds of things. Again, like I was thrown in to be a biz dev exec at a large green tech startup. And then they put me on as an executive for communications at a public company, did a reverse merger. So I ended up doing that. And then they put me in charge of structured products where I had no idea what structured products were. And then I ended up kind of learning, and I never said no. I think that's my biggest thing, is like I never said no to an opportunity to learn something and like stop and ask like, okay, how does this fit with my strategy? Just kind of like fit in. And all of a sudden I find myself now at the trajectory of everything that I've done in my life that has come together to help reach this stage where I can finally put the piece of the puzzle and say, wow, this is what financial world looks like in the post-blockchain, post-crypto, post-AI, post-government as a service world. And so, I think it's people like you and I having this conversation today can really determine what it's going to be like to really own your assets, have freedom of movement of, person and assets, and being able to create your path as we go into more and more uncertainty, as it seems like in the financial world and in the economic and political world. So I think really, I don't know what your journey is like. I know you having me on your podcast, but I'd be really curious to know how you got to the point of what you're doing today.
Well, sure. I mean, now I feel like extra pressure on this discussion. You're saying our conversation is going to pave the way to the future here. The destiny is in our hands. Well, yeah. So my quick background, I was an academic economist. I was interested in the Austrian school, if you're familiar with them. My specialty was money and banking. And I became disillusioned with academia. And it was kind of thing where, you'd spend years writing on some narrow topic. And then especially if what you were saying was controversial, well, the journal editor, who are they going to send it to except the existing leading figures in that niche? And if you're saying they're wrong, they're going to say, no, this guy doesn't know what he's talking about. Right. So obviously being a bit glib, but I'm just saying I was realizing that this system is kind of screwy. So anyway, I ended up in the financial sector, and at some point I came across a system of how to use cash value life insurance, not just for the death benefit, but as a way of managing cash flows. And so I helped develop a training program to teach people, how to do that. And then one of the graduates of that program was Cole Snell, the CEO of infineo. And he said, Bob, I know you're an economist that knows about life insurance, and I know you know about blockchain because I had done stuff on Bitcoin. He said, we're doing infineo is we're taking life insurance and putting it on the blockchain. And I said, that sounds interesting. Tell me more. I met the team, realized these are the people that are going to do it, and I want to be a part of that. So that's kind of how I ended up here.
That's super interesting, Bob. I mean, and also how you meet the people that you end up creating really cool things with, right?
Yeah.
In life.
Right. And what you kind of touched on too, that there's a lot of stuff that I had done, like, in grad school or whatever, just sort of like theoretical, decentralized mechanisms of rule enforcement and things like that. And in a theoretical, and, in principle, this could happen, but there's all kinds of frictions involved in the real world. That would just, and then now realizing that, no, like you say, blockchain and AI solves a lot of those things that we can actually go do this stuff that before I was just sort of daydreaming about. And so it really is interesting to see a lot of these efficiencies that we can, become manifest here. Can I ask you for what might sound like an odd question, but I've never been to Israel. So when you were talking about the family offices, is there a financial sector where all the main businesses are, on the same street there, or is it not like that?
Oh my God. Yeah. So we do have, I think all of Israel is called like the Silicon Wadi. Wadi is an Arabic valley. And no. So we do have the central area, and the government's been trying to push that out. But no, we don't have I'm not even sure that Wall Street is really Wall Street anymore, kind of like.
Right. Yeah.
Yeah. So, but yeah, the financial centers still remain, New York and San Francisco to a large extent. But, when I moved here, I never knew we had more startups per capita. We had more startups that have done IPOs per capita and more investment for. And then when blockchain came out, we had more blockchain startups per capita and stuff like that. So it's fascinating to be in this environment and want to be somewhere else at the same time because everybody wants to be in the US.
Okay. Yeah. And then one other, just for my personal curiosity, did you guys have like a huge housing bubble and bust too? I'm just not familiar with Israel's data. Like, did that happen there? I mean,
that's a great question. So no, in 2008, we did not. And that had to do with, actually, you're talking about the Austrian School of Economics. So that had to do with the government's monetary policy. Mm-hmm. And kind of, I don't know what it is. I'm not following that closely anymore. I used to also do economics. I have an unfinished PhD in that. And so I'm not following that anymore, but I know that we were one of the only ones that really avoided the effect. Obviously, the crisis trickled in because there's less money to invest in our startups. But nowadays, what I'm usually teaching and talking about is the fact that in the age of AI, the most important thing for population and like employment and investment and things like that, it's going to really be resilience and the ability to quickly change and adapt. And specifically, we're very, very good at that. And so I think that's also making us, go to the forefront of innovation and AI, specifically now that everything is irrelevant within a year or two over in any industry almost.
Yeah, definitely. So maybe is this the point to explain, because you're the CEO and co-founder of DIBS Capital, do you maybe want to explain what that is, just to give more context as we continue with this?
Yeah, for sure. So DIBS Capital is a network of broker-dealers and other type of monetary or financial intermediaries for them to work together and to connect sell side and buy side of any private deal. And the reason that the need for that exists is that the majority of the assets in the world are in fact private and not publicly listed on an exchange. And so anybody that's invested in the private market observes their capital just basically sitting there and not being able to leverage it in most situations, not being able to sell it and benefit. And so that's, every time that happens, the lack of liquidity leads to kind of a stagnation. And anytime you want to expand the economy, again, we're talking about that concept, you want to make sure that the money can, or the assets can exchange and flow, right? Actually, I'm curious to see what you think about that. What is your view on liquidity? Why are you guys tokenizing insurance?
Okay.
Why do private assets need liquidity?
Okay, great. Yeah. So for the case of life insurance specifically, it's this huge $3 trillion industry, and yet there's not a robust secondary market for it. So in the US, back, I think it was in 1911, there was a famous Supreme Court ruling that established that no, life insurance is property, and if somebody wants to sell it off, they can do that, even if there's not an insurable interest in the person to whom they're selling it. We're going to defer to the individual. You can do that. Okay, where like in Canada, that it's not as developed there in terms of the transferability. So so it's a robust asset, and yet there's not, there's all kinds of market. You want to list your house for sale or something, you can go ahead and do that. And yet in life insurance, it's still very, very small. And part of the issue is that conventionally right now, there's what's called the life settlement industry. And typically, I'm painting with broad brushstrokes, but the people, outside investors who might want to, take somebody's policy that the person's thinking of getting out of their policy, and the outside investors are saying, oh no, we'll keep it alive. We'll buy it from you and we'll make the premium payments. And then when you die, we'll get the death benefit. That for them is just a play on the death benefit, which is fine, but that's not what we're doing. But also that's only a very small segment. So that's why, like, what people see on TV, the ads for these life settlement, it typically shows older retired couples, frolicking on the beach or on their yacht or something, and say, hey, you don't need your life insurance, sell it to us. But they show older people because they basically don't want you living more than 6 years or so, for their numbers to work. Because again, they're just banking on the mortality. Right.
Well, what's going to happen in 10 years when people stop dying?
Exactly right. So that's a threat. So, but what we're doing at Infineo, and what we're interested in, again, is these policies, permanent ones that have cash surrender value, it's called, where it's the cash play. So, the kind of policies we're interested in acquiring, or just providing a market for, facilitating or fostering the development of an exchange, that's it does to us, it's just the cash value marches up over time. Like that's why the kind of investor who might want to plug into our ecosystem would be interested in. And so for us, if the person's 30 years old and just, you know what, I don't want to keep up with this policy anymore, we'd say, oh, instead of surrendering it back to the carrier, you can get probably a higher deal. Instead of just looking at the carrier who issued it, let's look over all of planet Earth. Surely there's someone out there that, values your policy more than this carrier does in terms of the contractual buyback clause. And so that's part of it. And and there's different frictions involved as to, well, why doesn't this exist already? And I think the reason is just by us tokenizing it and then using regulatory and legal things that have only really been solidified in the last few years here in the US to make this, so that you understand, yep, this is a valid property right. And, that if I own this token, I own the economic rights to the underlying, pool of assets. That's only relatively recent. So now that you have that infrastructure, we can develop the liquidity. So to answer your question, again, there's these
products, right? Like also when you can combine that, almost like insurance.
Yeah. So the quick answer to, what I could have just said is that there are these assets in life insurance that have a high value, but they're extremely illiquid. And what we're trying to do is just, bring down the barriers of that to enhance the liquidity. So people now can, find more buyers who are willing to put bids on their policies and things like that, or just to borrow against it.
Yeah.
That's just another example. It's just a lot easier to collateralize now if it's in a pool, and, we can give sort of common characteristics of it, and outside lenders who understand the nature of this kind of collateral can, and make loans against it. We can just, bring efficiencies in that way.
Yeah. And you guys are only dealing with life, traditional life insurance, or also care of life and stuff like that?
So, right. So right now, the type of policy that we can onboard into we call it a policy ledger. Our life insurance policies, either term or permanent. Now, some of those do have built-in provision, like what they call them riders of, long-term care and things like that. But right, a separate long-term care policy right now, we're not, onboarding that type of thing. It's just life insurance per se.
Okay. Understood. Very, very interesting. Fascinating. Great job.
Oh, well, thank you. And we're excited about what you're doing too, which is why we wanted to have you on the show here.
Sure. You want to know.
Okay. So what about FIBREE? You're the regional co-chair. That's also something that's up our alley. So can you, what does the acronym stand for? And can you explain what you guys do with that?
Great question, Bob. I don't think anybody knows what the acronym stands for.
Okay.
But it's essentially the think tank behind the use of blockchain in the real estate industry. Mm-hmm. In fact, it's super, super important because we are working to share our knowledge, especially in regulation, best practices, compliance, working with governments, use cases, and so on with each other. Because with this work, with this type of work, every time you touch insurance or even blockchain technology for a variety of use cases, we need the government and our various regulators to be on board. And so I've worked with a number of jurisdictions in Israel and in Saudi Arabia and Dubai and some countries in Africa on advising the regulators and the government on what are the best practices, for example, of custodying assets, of tokenization, of course, applying blockchain to real estate within various use cases. So that's basically what FIBREE does. And my job is to, number one, take that knowledge and apply it locally when the local regulators or agencies, governments, and so on, they will consult with us and with me in that capacity, and vice versa, bring the knowledge from the local use cases out to the world.
Okay, great. Yeah, I've noticed a few times here you've said how it's important that everything is in the the daylight in terms of the regulators and whatever, and that's what we're doing here at Infineo too. That we want our products to be institutional scale, and quality. That a major money manager or something, instead of we'll say, hey, why don't you scale back your holdings of treasuries and hold some of our sound token? You know what I mean? And we have to be able to show them that no, what we're doing is completely fine vis-a-vis the SEC and so forth. And that's exactly what we're doing, because we realize this is an important thing. And if you're going to have a major product like that institutions can own, it's got to be compliant.
And also institutions are not necessarily the super innovative type of agent. So, but they're getting there. They definitely want to be a part of it.
Yeah. So maybe can you speak a bit there? Like how is it in Israel in terms of like, does the average Israeli hold Bitcoin, for example? Like can you give us a sense of, what the adoption
Sure.
is there?
So just to clarify, I'm Israeli and I live in Israel, but our company is US based, Delaware based, because many, despite what everybody thinks in the world, the US market remains, in my opinion, one of the most open and innovative in terms of both blockchain and crypto, especially when it comes to the securities world. But to answer your question about Israel, actually, the Israeli government, the Israeli market is not that thrilled, I guess, by the crypto development. A lot of people own Bitcoin. Now they opened up another channel through a local banking app to be able to own. I don't know if that's a form like an ETF or some sort of a Bitcoin derivative for up to $250, which is not a huge amount. There are a couple of local exchanges that you're able to, that most people use, but the banks are not allowing people to easily withdraw any crypto-related crypto derivative money. Unlike, let's say, Bank of America, that company-wise, let's say we connect to Gemini, for example, exchange, New York-based exchange, and nobody's giving us any problems. So in that sense, I know that banking industry, especially banking as a service in the US, is becoming much, much more challenging because there's a big pressure on Silvergate and other, large banks to stop offering banking as a service to crypto companies for whatever reason. But it's still better than many other countries, I would say.
Okay, yeah, that's interesting. Because there is a mixture of opinion for the guests we've had on this that have an international presence.
Yeah,
and yeah, some of them think that the U.S. regulators are behind the times, and no, they're much more progressive in some places in Europe, for example, they get it, or certain Asian jurisdictions. But yeah, I guess you're saying though that. So how much is it like the actual regulation versus just the U.S. market is so important that no, you got to play ball there?
So there's always this regulatory arbitrage, right? And the regulator in the U.S., specifically the SEC, will look at what's happening and then will not necessarily be super clear, like it wasn't. And then there was a big issue with custody of securities, for example, and broker dealers and things like that. But they will, a few years observe and then, go after certain players. In Asia, ICOs, for example, utility token offerings are much more prevalent. There are countries that are not, as concerned with their citizens. And by the way, the citizens themselves are not as concerned about losing money because they're generally investing small amounts of money. It's basically like lottery, I guess. Mm-hmm. And so you cannot do an ICO anymore in the US. And I think that's a good thing. And we need to really be vigilant. And it's more important than ever right now for people to receive financial education and to understand that, yes, you have a lot of opportunities. Opportunities are dependent on the risk. Like the size of the opportunity is dependent on the risk. Are you able to take that risk? And so in that sense, I really do think that the US regulators are doing a good job. I don't know about them, going after certain crypto companies and so on. There seems to be some extra zealousy over there. But the overall movement, I think is good for everyone.
Yeah. And like I say, I mean, we just know that if this is going to become commonplace and things are going to be doing it, and it's a household activity that, oh yeah, you're going to own some of your assets or tokenized real world assets, things like that, whether it's real estate or life insurance, that it's got to be something that the government is aware of and it's regulated just in order for that to be feasible. That it's not like everyone's going to want to engage in black market or, hidden things. So it's got to be in the daylight. And like you're also to your point too, that, on our end, in terms of planning that, at some point, the token that we have, we call it the sound token. That's going to, again, it's like a fractional claim on this pool of life insurance, even though life insurance per se is not a security, that this token, we were saying, well, that seems like it's a security. And so we said, all right, let's not try to be coy. We'll just go ahead and register it. And it's a security token. That's what it is, and so, and when you say, once you just decide to do it that way and not try to be coy, it's actually pretty straightforward. So I think a lot of the people that are complaining about the US's regulation. Like it's because they think like, oh, well, why should I have to do all this? But it's not that the rules actually at this point are confusing.
It's all about, I think it's just super, super simple. Like, do you feel comfortable with your audience, with your buyers being able to, losing their money? How comfortable are you with that? If they're VCs, if they're family offices, other types of entities that are used to, taking the risk, losing the capital. I mean, yeah, that would be a security. I think it's just also common sense, right?
Mm-hmm.
If without getting into the definitions and the tradability and derivatives and things like that, that's pretty much it. Like if you buy stocks of Amazon or Microsoft or anything in the public market, there's reasonable assumption that there are reports, all kinds of, you want that to be the case. It's not always the case, but I think shady things happen, but usually these shady things are caught. In these more private settings, if you have like private funds now tokenizing insurance or tokenizing other things, there's not as much vigilance and audit on that activity. And I don't know how you explain that to the mainstream person, right?
Right.
So I think you guys are doing a great thing. I think with time, also the definition of who can buy security is in the US especially is really becoming less stringent, because now you can actually go take a test and become a qualified investor, right? I'm not saying that only VCs or family offices know what they're doing. Regular people also know what they're doing, but maybe they need to show to the sellers of set products, yes, I know what I'm doing. I've been in the investment business for so many years. I understand the risks. Sure, go ahead and buy it.
Mm-hmm.
Yeah.
There's a little bit of a tension. I don't know if you've encountered this, where some of the people who were early adopters, especially in Bitcoin, for example, they did it because they liked the privacy, they liked the pseudo anonymity and whatever. They were against the convention, like the way they might put it is, I don't like the Federal Reserve and I don't like Wall Street. That's why I like Bitcoin. So it's interesting. Like, so some of those people are, we call them purists or whatever term we want to use.
Yeah.
And I've noticed the resistance in that community to the tokenization of real world assets, because they think, no, blockchain is for Bitcoin, end of story. You're trying to mix different things. Have you gotten encountered any of that sort of attitude in terms of what you're doing?
So actually, I'm not looking too much into kind of the sect. There are different people doing different things, using different assets, using different philosophies for whatever reason, So I'm not judging anyone. I'll tell you a different thing that's related though, and not specifically in that community, but crypto community in general. A lot of people came to crypto because they did not have access to investing in a legit way in other assets, especially globally around the world, buying US dollars, even, in some countries, or access to stocks. Like, where do you trade stocks? Well, in the US, you have 60% or more individuals trading stocks actively on like Interactive Brokers or Robinhood, and even more have their investments through pension funds and 401k and so on. But outside, not so many people trade, not so many people have, stock portfolios. And so crypto gave an opportunity for people to invest, and that's amazing, right? So you would think that those people need those opportunities even more to invest in more stable assets than crypto through tokenization. So, and they're open to that, but they don't have a lot of times enough financial education. And then there's this other segment of which is a spectrum of people that kind of treat it more like a lottery. They're expecting very, very high return, right? Because they think it's super high risk, right? So maybe they even have a portfolio, right? But that's how institutions also view it. It's an ultra alternative asset. But at some point, though, it even started to replace real estate as an alternative asset. I think that there is maybe a pushback against that a bit, but I haven't checked the stats lately. But in general, there's this spectrum of people that are expecting crazy returns, and which is individuals, and usually outside of the US, sometimes then investing in ICOs and things like that, trading. And then there's institutions that also do that, and they actually manipulate the crypto prices in a certain way. Institutions don't really need tokenized alternative assets because they have access to all the alternative assets that they want. So I'm not 100% sure from the tokenization point of view if it really gives a lot of value to them. I would love to hear what you think, because you mentioned institutions. Maybe on your side, it's more of a tool for institutions to get involved and diversify and maybe even give a specific ownership access to their clients, or maybe combine it into structured products. So that's where I'm trying to explore what you guys are doing. But otherwise, for tokenization in general, it seems like those who are buying things in smaller quantities and need access to assets, that's a really good solution for them.
Okay, great. Yeah, to answer your, thank you. And then, to answer what I think you're asking me. So, right. So right now, as I mentioned, if you somehow could assemble a pool of 100 of curated whole life insurance policies of certain characteristics, that pool might be right now growing in terms of the cash surrender value. If you turned it back to the carriers and the money you'd get, that might be growing at 4.5% per year right now. But then on top of that, that pool, the interesting thing, and there's very low default risk. There's all kinds of procedures in place or whatever, so that it's going to be there. But more interestingly is there's zero interest rate risk, because that it's contractually guaranteed that there's a floor on the market value. So even like 10-year treasuries, that's not the case, right? Interest rates spike, the market price drops. So it's a very interesting asset. But if you say like right now, so why isn't an institutional money manager assembling a portfolio of that? Well, there's some real world friction. So one thing is they couldn't just originate the policies on their own, because you got to, prove insurable interest and things like that. Also, to get to the number I just, kind of pulled out of the air of 4.5%, the policies would have to be, 8+ years old for that to be true, right? So if you were going to do it from scratch, you would have to wait a long time. Then, so you say, okay, well, we can go in the secondary market and acquire them, but there's a lot of licensing involved and things like that. But then also, even once you got the policies, you might have to keep making premium payments on them, right? So it's a very clunky thing. It's very, so it's not just, I'm going to put in 8 million here and hold it for 2 quarters and then maybe scale it down a little bit. Like you can't do it like that. It's very clunky. And again, there's continued cash you got to pump in. So that's, so that paves the way for why, some company that does it for you. So it's true. In principle, you probably could do it in an analog, conventional way without blockchain, but using blockchain gives us access to sourcing and to originating them.
Yeah.
The individual who just has one policy and is thinking about doing something with it, like for that person, just to be able to tokenize it, now that opens up a world. So that, that was originally what we were doing. We just wanted to democratize it, to just open up the individual. And then we realized, oh, wait a minute, if we already have that up and running, it would be easy for us on top of that to then go ahead and buy some suitable policies that we have the NFT pointing to, put it into a separate thing, so that's kind of where it came from, right? So it wasn't, the original vision was not to bring this to institutions, it was just to democratize it. But once we realized what we were building, it was like, oh, this is a pretty easy thing to do too.
Oh, it's really cool. And while you were talking, I was thinking how in the US, you have something that's called an exchange fund. That's for private equity, which is something actually that the direction that we're working on. Anybody with a private stock, if they were to exchange that for a stock in a fund that is a diversified version of that stock and others, it's actually a tax-free transaction in the US. So if I were the holder of the insurance, and you came to me and said, I want to contribute that to a fund, and we'll give you a piece of that, right? And that actually reminds me more of a combined version of what you guys are doing in Lemonade, if you know that company, where...
Yeah, you remind me. I have heard of them, but now would you remind me? I don't want to misspeak. What are they doing?
So they're basically, if I'm remembering it correctly, they essentially are doing more of a combined policy. It's not fractionalized, but basically they wanted to reverse the whole risk situation, where instead of rewarding you for always claiming and, basically there is kind of like insurance versus me. Insurance doesn't want to give me any money. And if I got into a car accident or something like that, I have to do all the claims and so on and so forth. So the whole pricing premise is based on their methodology and technology, which I don't want to really misspeak on either, because it's been a while since I looked at it. But if I remember in the next 15 minutes, I'll come back to it.
Yeah. I'm just looking. Yeah, just it does seem. Yep, a general insurance provider, different types of insurance. Let me just circle back though. So at DIBS Capital, I just want to understand. So let's say I have a family business and then we want to raise capital.
Yeah.
How does that work? Do we go to you and then you tokenize our assets, or you tokenize the equity in the company per se, or how does that work?
Yeah. So we started with real estate, and the company was called Solid Block, and we changed the name last year. And we basically, real estate industry was more of an MVP industry for us. But essentially, what we realized is that tokenization essentially is not the means to an end, but it's a fantastic way to ensure, record keeping and the security of transactions, which, by the way, another thought that I had, which we didn't mention, is that blockchain really is one of the ways you can ensure there is no fraud and so on, because the smart contracts require, everybody to do KYC, AML, accreditation, make sure certain processes happen. And so, in that situation, the regulators should be over the moon that we're using blockchain and not the other way around. But essentially what we do now for companies, and we work more with late stage private equity firms. And so what we do, number one, is allow founders and early investors to be able to sell their shares, and to basically either exchange that for a fund that holds those shares, or basically find a buyer. And the way we do this is, there's just no market for private equity. Number one, because there is no NASDAQ for private equity, a marketplace where you get automated settlement. So there's no such thing. And so it's very expensive to sell private equity. You have to have an intermediary, a broker of some kind, and you have to have pricing, and it's just very, very hard. And so there's no market. And another reason is that it's very small. Like the whole market of people that are interested in buying private equity is small. Buying and selling is small as well. And so if you want to sell your stake in your company to cash out early, it's going to be very hard for you, because who else is looking for that specific industry, that specific company? So what we did is that we said, wow, we already have agents that are really good at selling or buying, or helping others to buy or sell. And these are broker dealers. And the problem is that also, broker dealers either have buyers or sellers. Usually, they work with a lot of buyers, and then they go and look on their behalf for some product, or they work with a lot of startups or companies or assets to sell them. So we realized that if we were to create a way for them to meet each other, it basically creates a market. So it's basically like having a decentralized version of NASDAQ. And we created automated settlement for private equity, which is awesome. It's smart contract based, blockchain based, and connected to bank accounts, connected to payment methods, and all the compliance.
Okay, yeah, that actually flows in. The next question I was going to ask you is just, looking over the personnel you got listed at the website, that somebody just specializes in smart contracts. So I was going to ask you, so that's just pretty standard with all your deals, that there's smart contracts built in?
Yeah, so smart contracts are built in. So the tokenization, we're using that to basically trace every transaction to a specific broker. So what we found by being in this industry is that tokenization is not like product that people will go and buy and companies would buy. It's basically like a means to an end, not the end in itself. So we're not selling tokenization or process. We're basically selling connection to brokers and the network of brokers that go out and sell. If you are a equity holder, and if you're a broker, then you're getting an extensive network of other brokers that you can connect with and then sell or buy whatever you're looking for. And everybody makes commission, because on the blockchain, you have everything, like a full chain of the transaction listed. So you know which broker brought which investor. And sometimes you have maybe 10 brokers on the way that all split the transaction fee. And that's what blockchain is super useful for, to do that. And so we are recording all the transactions, and smart contracts are there to facilitate and require compliance. So you're only able to buy or sell if you went through KYC ML accreditation, and there's just no exception for that, as that's the nature of smart contracts. There are sometimes there are restrictions on when you can sell securities on the secondary market. So if you bought something, you might need to hold that for some time before you can sell. And again, smart contracts are super useful for that, because then, it's smart contract, meaning you have to fit a certain criteria before you can execute a contract. So you're stuck, and you're stuck in a good way, because that's regulation. Somebody's going to get fined or jailed if those rules are broken. So we don't want those rules to be broken. So that's amazing. And the final smart contract is that if you're a broker and you facilitated a sale, then you need to get your commission. And so who's deciding? There's so many human errors performed. Like when brokers work together, it's like a big accounting nightmare usually. And there's lots of contracts. There's actually literally like 70 steps and different contracts to just get 3 brokers together and facilitate a deal. It's insane. So we automated all of that. And so we gave it off to a machine to go and deal with all, with how we split commissions, who facilitated the deal on which level, who's sell side, who's buy side, who's an intermediary side. And imagine how it expedites everything.
Yeah, it's funny the way so thank you. By the way, can you go like 10 more minutes? Or do you do a hard stop?
Like more like 5.
Okay,
yeah.
Great. Okay, I'll keep this snappy then. So, yeah, just to go along with what you said, we found a similar thing that we're not leading with, hey, we're using blockchain. Like we're explaining this is all the efficiencies and things we're doing. And then if somebody says, well, how come no one else has done that? We're like, oh, well, because we're using blockchain. And if you think it through, you really couldn't do some of the things we're doing without but it's not like you say, like, I don't care if it's using blockchain. And the company Figure, for example, is the leader here in terms of the model that we're following in that dimension, where they are using a blockchain, to give HELOCs to Americans, and depending on the situation, it might be a lot lower rate than what the person would get if they, went to their local conventional bank. But they're not, you could go out on their website and get it and everything, get your HELOC, and you wouldn't even know that there was blockchain involved. But yet that's why you get such a good rate, is because they've eliminated, 5 of the intermediate steps. Because like you say, with some of this stuff, how many different pieces of paper need to go here to there and, get signatures and whatnot. It's actually pretty amazing of that legacy. Okay, the last thing I want to ask you is, we got 3 minutes left here. I'll let you go. A few times I've heard you mention AI. So I'm just curious, did you know all along that was going to be involved, or is that something that's kind of crept in and you realized, or can you speak to that?
Yeah. So I think as I gotten older, and things still fall in my lap, but I've become more strategic about things. And I also saw that with the emergence of new industries. And I started kind of looking at the trends ahead of time. And as I worked in the financial industry, for example, I realized the social media and how businesses started using it. And so I created the social media marketing agency like back in 2014. I started doing social media at my fund of funds in 2012. And then I went into MPC, multi-party computation, and different cloud startups and advised. And then blockchain hit, and I was like blown away. And I said, this is going to change everything. But it's going to change everything when it starts getting combined with other things. And sometimes industries turn around. Like, for example, quantum was before blockchain and it didn't go so far. And then governments are still pouring money in it. Right now, the VC industry is waking up too. And AI has been, trendy and interesting for many years, but it just didn't have enough computing power. It just didn't have enough. It didn't have the social media. Mm-hmm. I mean, where did they get all the data, online, right? So when people started literally communicating online for every reason publicly. And so sometimes you kind of get these Venn diagrams of like several industries that finally came to life. I had AI startups like way, way before. And back in 2010, I think that was my first startup with my friend Alicia Outridge. And basically we did a version of a Facebook social graph. Like we would scrape Facebook profiles and other Twitter profiles on the others. And based on that, with like a human profile where we could connect people and let them do some sort of impactful things. And then she ended up at Facebook working on similar products a couple of years later and being very influential in that. And then I had a startup that we were taking Fitbit data and crossing it with financial data, like banking data, to understand how someone's mental states were influencing their spending habits. And then also, take that to the direction of lending, right? So like intention to repay, for example. So I've been dabbling in AI and I'm really super interested in it. And we've always looked at where that's going to take the financial industry, how this is going to influence everything. And now blockchain, in reality, like, when you have AI agents, for example, that are out there doing things on your behalf, it's super difficult for them to open a bank account, but they can easily open a wallet. Right. Go tell them, go get some diversified products for me by yourself, right? They can get an tokenized insurance on your behalf, right? Like they'll send you maybe, to go through KYC and stuff like that, if it's a security product, right? So they'll do that, but they'll go and open, do all the other stuff, right? So that's where things really are going. I'm always thinking about the human and the behavioral aspect of it. I'm more of a behavioral economist in that way. And I'm also looking at not only the things that are going to change, because we're all building stuff for 3-5 years from now, but also what are the things that are not going to change? Are people going to stop dying? Well, no, they're going to eventually die, but maybe many, many years later, right? So they're always going to have some form of a life insurance because there are accidents and things like that, right? Also, so life insurance is likely not going to go away, for example, right? People are still going to be spending money. People are going to be investing in assets. So these things are not going to change. So we're in this industry for a reason. Investment is, people are going to invest, much more than they do today in products that they have chosen. But, they're not stopping to invest. And so we're combining that with, wow, AI is here. And I don't even care what AI is going to do necessarily for the financial industry and the investment, but I care about the trends that people are employing. And I've been looking at my friends sitting on ChatGPT when it came out all day long, building investment strategies for themselves. They're like, if you had $1 million and you had this and this risk profile, where would you put that money? And then you're thinking, like, where does ChatGPT get that from? Right. And I did this for myself as well. And of course it said, Bitcoin or ETFs or whatever, right? Like, it didn't say tokenized real estate. What a bummer. So that's from my point of view, that's the AI shift that I'm looking for. Obviously, we're putting AI to a certain extent into our product to automate things, but everybody's doing that. So that's super interesting.
Okay, well, thanks. It's funny, I never thought of that. That you're right. Even if we had like the server speed and the power in 1990, there wouldn't have been stuff on the internet for it to scan, to train, to learn how to speak. So you kind of did. It was a horse and cart kind of thing. Okay, well, I will wrap up there. So, folks, my guest has been Yael Tamar, the CEO and co-founder of DIBS Capital. Yael, thank you so much for your time and your insights.
Thank you. I appreciate it, Bob. Thanks for having me. Good luck with everything.
Oh, it's the same to you. And thank you, everyone, for tuning in. We'll see you next time.
All right. See ya.
This concludes another episode of InFi, the Future of Finance, with Dr. Robert Murphy. The information provided is for educational purposes and does not constitute financial advice. Consult with qualified professionals before making any financial or investment decisions. For more information on the host and for previous episodes, visit InFi, thefutureoffinance.io. Thanks for listening.